Hedge funds are in some ways more complicated, but in some ways actually simpler because they are, at least historically, right, they invested only in publicly traded securities. And so your price is pretty obvious, right? You know what the market price is as of the end of, the quarter, the month, or, the end of the year. And so that has historically not been as much of a challenge. The challenge with hedge funds is, reconciliation and ensuring that cash is moving in the right places because you sell a position. You need to do something is going to happen with that cash, right? Where does it go? How do we manage it? How do we ensure it's being handled appropriately? With venture funds, and this is something I think a lot of LPs are going to be seeing now because everybody's getting their Q4 or end of the year 2023 capital balance statements. Things are illiquid. They don't trade. I think that, again, auditors and accountants could do a much better job of pushing VC funds on explaining and justifying valuations and really figuring out what the appropriate carrying valuation should be for a given position. And so I think to me, the financial piece is more acute in hedge funds because hedge funds are taking their 20 at least on an annual basis, whereas VC funds are not really taking that 20 until there's actually an exit. Nevertheless, they are or do have incentives to be creative with how and when to value positions and when to mark up and when to mark down, because ultimately, right, VC funds are going to be out fundraising every 2 to 3 years. They need to be showing results. They want to have momentum. They want to have nice things to talk about in their quarterly emails or in their, at their AGMs. And so from a financial perspective, I think that hedge funds have a much higher burden in terms of cash controls and annual valuations because of that annual 20%. For VC funds, I think the incentives are just that they want to be able to show momentum when they go out to raise their next fund, and so obviously that creates certain structures or certain incentive perversions for them in terms of how they think about valuation. I think the other thing in VC is that you obviously, because these assets are not publicly traded, you can have different firms that are carrying assets at totally different valuations. Sometimes it's because they're in different share classes. Sometimes it's because one, maybe is on the board and maybe has information rights and knows a little bit more, and therefore they have a better ability to properly value the position.